Hi there. Ever wondered what people are talking about when they mention terms like bull market and bear market or blue chips and penny stocks? What about cryptocurrency versus shares? This quick video will teach you these terms and more. The stock market isn't just a convoluted puzzle filled with peculiar words and phrases. It has its own dialect, a glossary of terms and jargon that traders and investors utilize to communicate. And guess what? Getting the hang of this language is key for anyone who wishes to navigate the stock market successfully. It's like learning the basics of a new language before stepping into a foreign land. The better you comprehend this language, the smoother your journey will be. So let's go. First up, let's tackle the term stock. Imagine owning a piece of a company, say your favorite tech giant, automaker, restaurant chain, or even a new startup you love. Well, when you buy a stock, that's exactly what you're doing. You're purchasing a small fraction of that company, which is known as a share. A share can cost fractions of a penny or hundreds of dollars or more, depending on the stock company. And as the company's fortunes rise, so does the value of your share or shares. But what goes up can also come down, so never invest what you aren't possibly willing to part ways with. And that's no bull. More about bulls in a minute. Now let's move on to dividend. Think of it as a thank you note from the company you've invested in. Companies often distribute a part of their profits to shareholders in the form of dividends. It's their way of saying, hey, thanks for believing in us. This money is on top of whatever gains may have been made in the value, or in other words, the price of the shares. Next, we have two animal-themed terms that you'll hear quite often: bull market and bear market. Picture this: a bull charges with its horns up, symbolizing a rising market where the value of stocks are going up overall. On the flip side, a bear swipes down with its paws, symbolizing a falling market. So, a bull market signifies booming times with prices on the rise, while a bear market indicates a slowdown with prices dipping. You tend to see more selling of stocks when prices rise and buying of stocks when prices are lower relative to the initial selling price or value of the stock. Finally, we have blue chip. Now, this isn't about poker, but it's a bet many investors place. Blue chip companies are industry leaders, the big players with a history of stable earnings. Think of them as the all-star team of the market. Investing in them is often considered a safe bet, as they tend to weather market storms better than most. However, blue chip stock is often not considered cheap compared to the other side of the coin: penny stocks. This is a term used to refer to companies that may be newer in the market, may be a smaller company, or simply sell stock at a lower price per share. As the name suggests, prices per share can be in the pennies range. So those are some basic terms that you'll hear quite often, but there's more to learn if you're up to a bigger challenge. Continuing with our basics, let's delve into some more fundamental terms. First up, we have portfolio, which represents the collection of financial investments like stocks, bonds, cash equivalents, mutual funds, and other investment vehicles owned by an investor. So, think of it as your personal collection of investments. Since we're mainly focusing on stocks in this video, for example, you might own shares in your favorite blue chip company like Alphabet, which owns Google and YouTube, to name a couple. That's one stock. Let's say you also own shares in an up-and-coming coffee company that you believe in. That's another stock you own. All stocks or investments you own equals your portfolio. Next is index, a method to track the performance of a group of investments or assets in a standardized way. S&P 500, Dow Jones, and NASDAQ are examples of indexes and are relied on by some investors to keep tabs on overall market health and trends. It's like a barometer for the market or a specific sector. Now, we have volatility. This pertains to the degree of variation or changes in price over a given period of time. High volatility indicates that the price of the stock can change dramatically a short time period in either direction. Imagine it as the roughness of the sea. The rougher it is, the more volatile it is. This is often associated with risk. After all, we can't predict the future, but we can understand patterns over time. Well, that wasn't so bad, was it? Before we conclude, we're going to introduce a new player onto the field: cryptocurrency. Let's talk about how it differs from traditional stock market investing, and we'll equip you with some basics to help you navigate this new investing landscape. These are your initial guideposts, helping you start your journey toward investing. Remember, knowledge is power. The more you understand about the stock market and cryptocurrencies, the better your investing decisions will be. We've already traversed the realm of conventional stock market lingo. Now let's delve into an emerging contender in the field of investment: cryptocurrency. A virtual or electronic currency safeguarded by cryptography using what is called blockchain technology. Cryptocurrency boasts anonymity, security, and decentralization, or freedom, so to speak, of trading and transactions. Cryptocurrencies are notorious for their intense fluctuations, with valuations that can either soar or nosedive within a few hours. It's a tumultuous journey, and the prospect of substantial returns is tantalizing. But bear in mind, the hazard is just as significant. This isn't for the timid. Contrary to stocks, cryptocurrencies don't denote ownership in a corporation or qualify you for dividends. They're fundamentally speculative ventures. You're wagering on the presumption that another party will shell out more for the cryptocurrency in the future than your current investment. Consequently, whether you opt for investing in traditional stocks or cryptocurrencies, always remember to conduct your due diligence and refrain from investing more than your financial capacity can withstand. Ultimately, the ideal investment tactic is one that corresponds with your financial aspirations and risk acceptance. Knowledge is power. The more you understand about the stock market, the better your investing decisions will be. Thank you so much, and I hope you learned something.